Now we can transition into educational accounts, because these are also limit questions that we need to be comfortable with. Educational accounts. So I have 4 kids. They keep getting older. Not me, just them. So Miles is, oh my gosh, almost going to college, and my youngest is today in 1st grade. So these are things that I'm very comfortable with and very familiar with. So first we had the educational IRA. So when it was first invented, somebody for some reason thought it had something to do with retirement, which of course it doesn't. So it's called a Coverdell Educational Savings Account today. Coverdell. I was reading an article recently about the Coverdell. It has a very small contribution amount. It is after-tax dollars that go in. The most that can be put in is $2,000 per year per beneficiary. But the article that I was reading, and I'm not going to remember the rate of return. I want to say the rate of return in the example was like 6 or 8%, something that was, it was okay. It wasn't 12%, and it wasn't 0. Was talking about how with the Coverdell, if you put in $2,000 every year from the time the child is born, because yes, the baby must be born first, up till 18, because it does have an age, you can only contribute until they're 18. Assuming a rate of return of 6 to 8, I can't remember, I should have written it down. I read too much. You'd have 60 grand, which is not bad actually for kids going to college. I mean, sure, it's never enough, but it's better than 0, because really the most common complaint I get from students is that is not very much money. It's a lot better than 0. So $2,000 per year per beneficiary. That means that I can put in $2,000 and that's it. Or my mom could put in $1,000 and I could put in $1,000 for, let's say, Mason. He's 15. It's not for each of us can put in $2,000 for Mason. It's total per year per beneficiary, $2,000. It's after-tax dollars that go in. Earnings are federally income tax-free if used for educational expenses. So the ESA is the one that you can use for private preschool through higher educational expenses. Now, the Coverdell ESA limit absolutely must know the age requirement on it, so under age 18. And has a must use by age 30 rule that we covered in the general section of the course. It does have an income phase out. So just like a Roth, if you earn too much, you can't contribute to a Roth. If you earn too much, you can't contribute to an educational savings account. So based on your modified adjusted gross income. So if you're single, head of household, or married filing separately, the modified adjusted gross income is below, for 2016, $95,000. You can make the full $2,000 contribution. 95 to 110, the amount you can contribute is reduced. 110,000 or more, no contribution is allowed. Married filing jointly has higher limits, not double the limits though, just higher limits. Modified adjusted gross income below 190, full contribution. At least 190, less than 220, the amount you can contribute is reduced. 220 or more, no contribution is allowed. Once again, that's not the part that I'm worried about you knowing. I'm worried about you knowing that the ESA has an income limitation on it that the 529 plan does not, which is another reason why 529 plans are more popular. So ESAs do have an income limitation. 529 plans do not. So we'll talk more about 529s in just a minute. The ESA has a must use by age 30 rule, with the exception of special needs children who do not have to use the money by age 30. If, let's say, Max is 30 and he hasn't used all his money in his ESA and I want to preserve the tax deferred status, potentially tax-free if the earnings are used for educational expenses, what do? I roll it over. And very oftentimes the test wants you to know to whom you can roll it over. So a son, daughter, descendant of a son or daughter, stepson, stepdaughter, brother, sister, stepbrother, stepsister, father or mother, or an ancestor of the father or mother, stepdaughter, stepmother, son, daughter of a brother or sister, nieces, nephews, brother or sister of the father or mother, aunts, uncles, son-in-law, daughter-in-law, father-in-law, mother-in-law, brother-in-law, sister-in-law, the spouse of any of the individuals listed above, even to first cousins. So it's quite an exhaustive list. Can you roll it to a friend? No. not for the ESA and not for the 529 plan. But you can roll it within the family, and it's a very large family tree. Very large family tree. And in the end, if the money is used for something like remodeling the kitchen, because nobody needs the money, you'd owe ordinary income tax on the earnings plus a 10% penalty because you're not using it for what it was designed to be used for. And that same rule would apply to the 529 plan. Can you have a Coverdell ESA and a 529 plan for the same person? Yes, absolutely. Granted, the ESA is only funded when they're under age 18. 529 plans may be set up for anyone. So 529 plans, another college savings vehicle where the educational savings account can be used for before college as well. The 529 plan varies by state. 529 plan varies by state. So every state chooses who they want to have administer their plan. And more often than not, it's a mutual fund company. So whether or not it's American Funds or Vanguard or TICREF, or it's usually, not always, but very oftentimes it's a mutual fund company. After-tax dollars go in, just like in the educational savings account. So neither the 529 plan or the educational savings account, to fund it, do you have to have earned income. You don't have to have, so grandma who's retired does not, she can still contribute. It's the ESA though that if you earn too much, you can't fund. Where the 529 plan, once again, you don't have to have earned income, and there is no income phase out. Anyone can contribute up to how much? I'll explain. So after-tax dollars go in, and you can contribute in a given year. So these can be set up for anyone, meaning there's no age, no under age 18. I could set one up for myself. Very oftentimes, I'm the owner and my children are the beneficiary of the 529 plan. For FAFSA reasons, I don't make the child the owner of the 529 plan. It's just worse for them for financial aid. So no age. How much can I put in a given year? This you have to know. 5 times the current year's gift tax exclusion amount. And then that ties into another question. What is 2016's gift tax exclusion amount? In 2016, I can gift away to as many people as I like up to $14,000. So I could gift you something, could be cash, could be shares of stock, could be a gold watch, whatever, nice watch. $14,000. Now I could gift you 20, but if I gift you more than the current year's gift tax exclusion amount, which is for 2016, $14,000, I, the person giving the gift, owe gift tax on the amount over the exclusion amount. So I would owe gift tax on the $6,000. Gifts are free to the recipient. You don't owe any taxes no matter how much I give you. It's free to you. Sign me up, right? So how much can I put in this year potentially could be a question that I would be sure that you can answer. So 5 times the gift tax exclusion amount. So you got to take the current year's gift tax exclusion amount. So you do need to know this one, and you have to multiply it by 5. So you could put in for your son, your friend, your nephew, your grandson, whoever, yourself, $70,000 this year. So very oftentimes a question will be something like, Grandma can put in how much into Mason's 529 plan in 2016? $70,000. And then I'm going to go call up Grandpa and ask him to do the same thing. So 70 plus another 70, 140. Let's say there's 10 grandkids. That's $1.4 million. This 2016, this year. When this happens, it's a speeding up of the gift tax exclusion amount. You cannot give a gift to that same person for the total of 5 years, right? So the subsequent 4 years. So if Grandma did this for Mason, put in $70,000, that would be fabulous. She couldn't give a gift to Mason for the 5-year period of time. Speeding up of the gift tax exclusion amount. How much money can get into a 529 plan before the state is like, that's enough money? Depends on the state. So, I don't know, my whole growing up, my life as a parent, people kept saying college is so expensive, and I just ignored them until we get to the point where you go, oh, college is so expensive. So it depends on where your kids go. I'm all for in-state, right? Out-of-state is so expensive. So very oftentimes the state will allow the balance to get anywhere between $350 being the lower end of the dollar amounts I'm seeing lately, $500,000, before they'll say, and it varies by state, no more contributions can be made. So how much can grandma put in for Mason this year? $70,000, 5 times the gift tax exclusion amount. Grandpa could do the same thing, Aunt Patty could do the same thing, until it got so big, and that would include earnings, that they said no more contributions can be made. So no, the 5 times the gift tax exclusion amount. And then, call up your relatives and ask them. I guess that's what I sometimes feel like I should do. Yes. 529 plans. It has this very similar rules as far as if, let's say, Miles he's my oldest, didn't use all the money, could I roll it to Mason, to Max, to Emery? Absolutely. Quite an extensive family tree. There is no must use by age 30 rule at all, though, on a 529 plan. So I could start saving right now for my PhD that I'll probably get when I'm 70, because I love school. So with that question, we learned 2 things. 5 times the gift tax exclusion amount is allowed into a 529 plan in a given year. And we also learned the gift tax exclusion amount for 2016 is how much? $14,000. Which brings us to the estate tax exemption amount for 2016. So this is also another one that I would know goes with the gift tax exclusion amount, meaning that they're topics that the test likes. So the estate tax exclusion amount, exemption amount, it's the same thing. For 2016 is $5,450,000. So you should know this dollar amount. This is what around my office we would call a princess problem. This is a problem you want to have and not a problem that everyone has. So let's say you're single, and then when you die, everything that you owned, your house, your investments, your cars, all the furniture in your house, your comic book collection is valued as of its fair market value as of date of death. And if everything that you owned was $5,450,000 or less, how much estate taxes are owed? Nothing, 0, because you're at the exclusion amount or less. It's when you're over the exclusion amount that estate taxes are owed. Estate taxes are really a transfer tax, transfer of the ownership of property to someone else. So it's only the amount that's over this exemption amount or exclusion amount that's taxable. And that's where I get to the idea of a princess problem, right? I'm probably not going to have this problem. So if when you die, everything you owned had a value, right? All of your assets, they figure out the values of date of death, was, to make it easy, $6,450,000. How much is subject to tax? Only the million that's over the exclusion amount. So that's this, if I could draw, pretend I can draw. I'm trying my hardest. So the million would be subject to estate tax, and it's currently 39.6 is the highest estate tax, same as gift tax, 39.6. So every once in a while you might read about the estate tax credit amount, which is a lesser dollar amount, and it's basically giving you a credit for the taxes that you owe on the first $5,450,000, because that is 2016's exclusion amount. So, and that's probably not a big deal on your test, but it's something that I get a lot of questions about. It's saying the same thing in 2 different ways. You're either going to see it, for the purposes of your exam, focus on the dollar amount. It's the amount over $5,450,000 that is taxable. And then every once in a while you see it as a credit, a tax credit amount. And it's a lower amount, it's 39.6, so $5,450,000. It's saying the same thing in a different way. So don't let that throw you off if you ever see that. Very oftentimes students will be like, what was that? No big deal, don't worry. Now remember in my example I said you were single. If you're married, when the first spouse dies, the best advice I can give you, which you're going to give to everyone that you know, is make sure at the death of the first spouse that Form 706 is filed. Oh, IRS Form 706. 706 is the estate tax form. And you might be thinking, well, I thought everything passed to the surviving spouse without taxes being owed. It does. It does. That's true. However, if you file this form, please file this form, you create what we used to have to create by meeting with a lawyer and drafting up a trust, what's called an AB trust or a bypass trust. We used to have to do this legal document to ensure that when the second spouse dies, 2 times the estate tax exclusion amount was available. Today, you don't have to do that. All you have to do is make sure that Form 706 is filed, it's due within 9 months of a person's death. Whether or not there's taxes owed or not, because oftentimes there's not. By doing this form, you will meet what we call portability, which is a relatively recent tax law change that allows when the second spouse dies, there to be 2 times the estate tax exclusion amount available. So basically, shielding in 2016, $10,900,000. It's only when the assets owned at the death of the second spouse in 2016 are over that amount that you would trigger estate taxes. So you can figure out 39.6% of $5,450,000, and that's the amount you'd be foregoing if you forget to file this form. Potentially, you'd be paying taxes on that amount. So it's a really important form. The portability requirement, the portability rule, this tax, it's like the nicest tax code that I have seen in a very long time. So it is a permanent. I love it when the Internal Revenue Service calls it anything permanent, but they do claim that it is a permanent rule, so long as that form is filed. Now, I referenced Form 706, which is the estate tax form. There's also Form 1041. Form 1041 is, well, let's think about this first. Let's go to Form 1040. What's that? This is a personal income tax form. Form 1041 is an estate or trust income tax form. Form 706 now is the estate tax form. So this word income, this just helps me if I think about it like that, because everybody knows what your personal income tax form is called, a 1040. So the 1041 is the income tax form for trusts and estates when they have income of $600 or more. Form 1041 is due April 15th, just like your personal return is due April 15th. Corporations have tax due dates of March 15th, and then Form 706 is due when? 9 months after a person's death. The gift tax exclusion amount for 2016 is what? We already covered that, $14,000. They also expect, they being the IRS, you to keep track of all the gifts you've given out over your lifetime. Not Christmas present gifts, but gifts of, oh, maybe you help your kids buy a house, so you give them the down payment. There's a lifetime gift tax exemption amount that is currently set up to mirror the estate tax exclusion amount, so $5,450,000. If you give gifts away during your lifetime, then the IRS is going to tax you on the amount that's over the lifetime gift tax exemption amount at a 39.6 tax rate, just like the estate tax rate. Generation skipping transfer tax. I want you to know just a definition here. Depends on your test. You might not even see this, but I'll cover it just in case. The generation skipping transfer tax is a tax that's assessed on property that is passed from one generation to a generation that is 2 or more below the person giving the gift. So it's grandpa to grandchild, or someone that's 37 and a half years or more younger than the person making the gift. It's subject to the generation skipping transfer tax. So it does, the generation skipping transfer tax, have an exclusion amount. It mirrors the gift tax exclusion amount, which mirrors the estate tax exclusion amount, at least in 2016. It's $5,450,000 if you do gift to someone 2 or more generations below you more than the exclusion amount in 2016, you're subject to the 39.6% tax rate. The kiddie tax exclusion. Kiddie tax. What is this? So let's tell a story. So back in the day, you've probably heard this story. When I was young, many moons ago, my girlfriend, we were in high school, and her parents sold their house in California and put all the money, lots of money, in her name and invested in the stock market. Because way back then, the kiddie tax age was under age 13. And so all of the investment income was taxed at my friend's rate, which for the parents was quite a great deal. So the IRS said, wait a second, that doesn't seem right. So we have a kiddie tax rule, which has to do with the tax rate on unearned income for what the IRS defines currently as a kiddie. So this age went up from under 13. It went up a couple different times. So this is where it's at currently. So know who is a kiddie. And know what we're talking about here is investment earnings, unearned income. Not the job, my son works at Papa John's, he makes minimum wage and he's building character. Not that. This is investment income. So whose tax rate is this investment income taxed at, basically, is the question. So first we have to determine who's a kiddie under the current tax rules. So someone who is under age 19 or under age 24 if they're a full-time student. So let's say Max, just talking to Max the other day, he's 13. Oh, what an age. He said, I really want to be a firefighter. He's always wanted to be a firefighter. Do I have to go to college? Oh, Max, he's super smart and super hates school. So I said, no, you don't have to go to college. So let's say here's Max, he's a firefighter, right? I guess he's not a firefighter yet for my story. He shouldn't be. He's 18 and he has investment earnings. Are they taxed at his rate, because he's 18, or are they taxed at the parent's marginal tax rate? Now, the marginal tax rate is the tax rate you pay on the last dollar you earned. The last dollar you earned, which is the highest, which is different from your effective tax rate, which is like an average tax rate. So we have a progressive tax system. So your earnings, the first chunk of earnings is taxed at a lower rate, the next chunk at a higher rate, and then the last dollar you earn is taxed at the highest, what we call marginal tax rate. So if Max is he's 18, and he has investment earnings, basically. Does he meet the definition of being a kiddie? Yes. Let's say he's 22. He's not in school. Now he's not a kiddie. It's only under 24 if he's a full-time student. So if he's a full-time student, he's still a kiddie under 24. If he's 22 but not a full-time student, then it's taxed at his rate. If he's 18, taxed at the parent's marginal tax rate. Now that's the kind of simplified version of the rule. And 99% of the time, really, that's all you need to know. However, a lot of times I'm teaching a live class and students start to get this funny look on their faces and I go, wait, let me help. There's a little bit more to it, actually. So when you have someone that meets the definition of a kiddie, so under age 19, under 24 for a full-time student, and they have investment earnings, there's more to the rule. Don't tell the test because they don't generally know this part of the rule. So what happens is there's no tax on the first $1,050 of investment earnings. There's no tax. So that's cool. There is no way your test is going to ask you this. But I am an accountant, actually, so I can't help myself. I can't not teach you this. The next So in a given year, this is 2016's rule, the next $1,050 taxed at the child's rate. So that in reality for 2016, if there is investment income over $2,100, which is, a nice amount, right? It's the amount over the $2,100 that is taxed at whose rate? At the parent's marginal tax rate. Sorry, I know that's a terrible place to write. Taxed at the parent's marginal tax rate. Now, the tests, like I said, they're usually not this smart, but I could see your confused face and you were getting worried. I always have students that start to get really freaked out about this. Really, the first investment income up to $1,050 isn't taxed at all, even if they are a kiddie. Doesn't matter. What else do they potentially want you to know? Know the age. Kiddie tax rule applies when they're under 19 or under 24 if a full-time student. A child who provides more than half of their own support is no longer subject to the kiddie tax rule. So, child that provides more than half of their own support is no longer subject to the kiddie tax rule. So that's more than you probably need to know. I can't help it. I'm sorry. Tax rates. Income tax bracket, the lowest bracket we have in 2016 is 10%. The highest tax rate we have is 39.6. Don't worry about the dollar amounts that are in there because that's kind of my thing. Long-term capital gains rates and qualified dividend rates depends upon your ordinary income rate. So if you're in an income tax bracket of 10 or 15%, which are the two lowest, then your long-term rate is 0, which generally if you're in the 10 or 15% tax rate, you don't have investment earnings, but if you did, they would be tax-free. If your income tax bracket is 25% to 35%, then your capital gains rate is 15%. If your income tax bracket is 39.6, which is the highest we have currently, your capital gains rate is 20%. So long-term capital gains results from selling a security that you held for a year and a day or longer. Also is the rate you pay for qualified dividends. If you have a non-qualified dividend, which I'll explain more momentarily, or short-term capital gains, interest on a bond, those are all taxed at ordinary income rates. You would always prefer the long-term rates because they're obviously lower. Ordinary income rates are higher. So what's qualified dividend income? Qualified dividend income is something that was on test for a while and then it went away. And even though it's still true in the world we live in, it's not a huge deal on the test, but I feel like I would be remiss if I didn't explain it to you. So dividends paid by a U.S. corporation or a qualified foreign corporation that you meet the holding period requirement for. So if you have dividend income, historically it's been taxed as ordinary income. If it meets the definition of qualified dividend income, which has nothing to do with a qualified plan, you get preferential tax treatment, which is a great boon for the stock market and a reason why we've got a lot of older clientele with dividend-paying stocks. Generally speaking, you're in retirement, your risk spectrum, your suitability doesn't ask you to own stocks at this point in your life, but because of this tax break, a lot of people will end up in this category because they like the lower tax that is owed on qualified dividends. Give me a choice of 39.6 or 20%, I'll take the 20% any day, as would anyone. So dividends paid by a U.S. corporation or a qualified foreign corporation that you meet the holding period for. So what is a qualified foreign corporation? It is considered a qualified foreign corporation, if it meets any of the following conditions. If it's incorporated in a U.S. possession, if the corporation is eligible for the benefits of a comprehensive income tax treaty with the United States that the Treasury Department determines is satisfactory for this purpose. It includes an exchange of information program. There are currently 62 countries, don't quote me, that changes sometimes, with such treaties. If the corporation does not meet one of those two requirements, but the stock for which the dividend is paid is readily tradable on an established securities market in the United States. So if it lists here, then the dividends paid are treated as qualified dividend income. Then the dividends paid are treated as qualified dividend income if you meet the holding period. So I wasn't entirely done. So readily tradable stock is defined as any stock, common, ordinary, preferred stock, or an American depository receipt in respect of the stock, considered to satisfy the readily tradable. Doesn't necessarily have to be, it has to be listed in one of the markets. So the New York Stock Exchange, the NASDAQ, they all keep buying each other. So they all kind of own the American Stock Exchange, Boston Stock Exchange, Cincinnati Stock Exchange, Chicago Stock Exchange, Philadelphia Stock Exchange, Pacific Exchange. There's really BATS, the NYSE, and the NASDAQ today. So if it's listed in any of those places, then it meets the definition of readily tradable, which was the third way in which a foreign corporation's dividends could meet the definition of qualified dividend. So what's the holding period? Because you might be thinking, ooh, I'm going to go buy a stock that's going to pay a dividend so that the income that I get is taxed at this preferential tax rate. There's more to it than that. The holding period requirement says that you must have held the stock for more than 60 days during the 121-day period that begins 60 days before the ex-dividend date. So the ex-dividend date is the day that the stock trades without the dividend attached. So we've got 60 days before the ex-dividend date. You must have held the stock for more than 60 days during the 121-day period that begins 60 days before. So basically what this is saying is you can't go in and out just to get the dividend and then have the dividend be taxed at this preferential tax rate. You have to have the stock in your portfolio for more than how many days? 60. Now, when counting the number of days that you held the stock, include the day you disposed of the stock, the day you sold it, but not the day you acquired it. So it's got to be, there's a 121-day period that begins 60 days before ex-dividend in which you have to have it for more than 60 days. Payroll tax rates, I put them in there because every once in a while there's a concept about when you have earnings, and you go to work somewhere, you're not self-employed, the employer contributes into Social Security, Medicare, and then how much would you contribute if you were self-employed? So the individual share of Social Security is 6.2, the employer match is 6.2. The individual, that's the employee's, share of Medicare is 1.45. The employer share of Social Security is 6.2. The employer share of Medicare is 1.45. If you're self-employed, all of those become your responsibility. So you pay the employee and the employer percentages. So it's a tax for Medicare and Social Security, of course. How much income is subject to Social Security is $118,500. How much of your income that you earned in 2016 is subject to the Medicare tax? All of it. So there is a cap on how much the 6.2% is applicable to. So $118,500, and then Medicare tax is all of your earnings are subject to that tax. There is still a child tax credit, which is $1,000 per child if you're eligible to claim it. There's not any more on that I'm going to do. Personal exemption phase out is an idea, generally, simplistically. You're married, you have 3 kids, you get 5 personal exemptions on your tax return. And the dollar amount for each person is the same whether or not they were alive the entire year or the baby was born on December 31st. You've heard those stories where people want to have the baby on December 31st, and that's for tax reasons. Always cracks me up. But if you earn too much, how much you get for the personal exemption amount goes down. I don't expect that you'll need to know where that amount occurs. It's in the handout. It's in the PDF, I should say. But just know that there is this takeaway of the personal exemption amount depending upon your income. There is also what we call the PEACE provision, which is an itemized deduction limitation depending upon a person's income. So both of these, the PEP, personal exemption phase out, and the PEACE provision, if you're married filing jointly, will take effect if your income is above $311,300 in 2016, or $259,400 if you are single. So there is a reduction in how much you can write off in your itemized deductions if your income's too much, and then you get less for your personal exemptions if your income's too much. And this is just, I suppose, they fixed the, well, they're just trying to make it more fair, I suppose, is why these occur. That's the intention behind it. So the PEP and the PEACE provision. That concludes our discussion of the 2016 contribution limits and current tax laws. Make sure that you read your key facts. Make sure that you practice your exam. It is a lot of numbers to know, so practice. And then when you see them on the test, you'll get all these questions right. Good luck.